I'm Bob Koopman, WTO's chief economist. This week we're going to announce how we see trade growing this year and next, and also review what happened in 2015. First, let me talk about the economic environment in which trade takes place today. There continues to be uneven economic growth across the globe, with about expected growth in the U.S., continued weakness in the EU, slowing growth in China, and declines in economic growth in Brazil and Russia. Falling oil prices were expected to stimulate growth in oil-consuming markets, but that has not occurred, and instead weaker growth in oil-exporting markets has had a bigger effect on trade than previously observed in historical trends. We're basing our projections on GDP estimates by the IMF, World Bank, and OECD, all of whom have revised their forecasts for 2016 and 2017 downward. Slower economic growth has obvious implications for expected trade growth. I'd also like to raise another element that has caught our attention recently. In the past few years, the volume of trade has been growing more or less at the same speed as GDP. This changes a trend in the past 20 years when we observe trade growing or shrinking much faster than the world economy. We believe this is due to such things as the slowing pace of integration into the global marketplace of economies such as China, India, and Central and East European countries, as well as stabilization in the pace of production fragmentation, the process where companies use global production networks to make their products. If these issues interest you, go to the WTO website on Thursday, 7 April for our full report and latest figures. For Twitter users, I'll be answering your questions on Friday. Keep an eye out for the details at WTO.